Hello everybody. So today I'm not going to cover any specific miner. I'm going to cover the business model of miners. And this video is a special response to typical comments that I get in my videos on miners, which is, why wouldn't you just buy Bitcoin, right? The hurdle rate is 50%. Why not just buy Bitcoin? A more advanced version of that comment is, why wouldn't you just buy MicroStrategy? That includes kind of the fiat dollar shorting and adds that back to the question. But essentially, before I go into this, I treat MicroStrategy and I view MicroStrategy mostly as a synthetic Bitcoin miner because of a software business and because of the Bitcoin yield idea, which will eventually manifest itself. Right now, they generate the yield through the volatility of the stock, but if they generate a yield through any other way, MicroStrategy at the end of the day would just be a synthetic Bitcoin miner. So the debate is do you want to have a synthetic Bitcoin miner, right? A company that just accumulates more Bitcoin through some artificial ways or running something else? Or do you want to have a company that acquires Bitcoin by actually mining it as it is written in the white paper, right? And so let's talk about Bitcoin miners, how they make money, how they can lose money, and kind of like the three boxes that rule this business. And so I have created a flow chart. I'm going to call this the miner flow chart. There's three moving parts in any miner. And some of them don't have a hodl bag, which is a problem for me. If I see a miner with no hodl bag, that's typically a red flag. And these miners who have no hodl bag, they trade at a discount typically. So there's three parts. The first part is the mining rigs. That's typically communicated in exahash. Cleanspark, for example, they brag, they say, oh, we're on our way to 50 exahash, right? That's probably 400,000 mining rigs like this one, 400,000 of those. The mining rigs is the first point of the equation. The second point is, of course, the Bitcoin that you've mined with those rigs. Do you accumulate it in a bag? Do you save it? And then the point number three is having access to power these mining rigs, because each of these machines is 3, 4, 5,000 watts sometimes. So think about a machine like this that's 2 dryers running 24/7. You need access to a lot of power. So power access is part of valuing a Bitcoin miner. The hodl bag, how much Bitcoin they're holding on balance sheet, that's the other part of valuing a Bitcoin miner, and how many rigs they have, how many hundreds of thousands of rigs, how many exahashes do they have. Now, what is it that influences the value of each of these boxes that make up a miner? Well, let's start with a simple thing, right? The accumulated Bitcoin, that Bitcoin that they hold on the balance sheet, it's got a full correlation to the price of Bitcoin. Price of Bitcoin goes up, accumulated Bitcoin goes up, 1-to-1. Now, what about the miners? Miners are a little more complicated. I will tell you that the miners over the short run, 3 to 6 months, they have a slight correlation to the price of Bitcoin. So over the short term, the value of a Bitcoin miner will fluctuate based on the price of Bitcoin. And if you go on bitmain.com and try to order a miner from China, you'll know the price will depend on the day and will depend on the price of the Bitcoin that day. A Bitcoin miner when Bitcoin is at 80,000 is much more expensive than a Bitcoin miner when Bitcoin is trading at 20,000. But that is over the short run only, maybe 3 to 6 months. Over the long run, on the other hand, the value of a Bitcoin miner is inversely correlated to the Bitcoin difficulty. So, I'm being funny here. This is the chart of Bitcoin difficulty. It goes up. How do I think about it? Well, simply inverse that. And so the more the Bitcoin mining difficulty goes up, the less the value of your mining rigs. Your mining rigs lose value as the Bitcoin difficulty goes up. And so over the medium term, you can have Bitcoin who goes up quite a bit, and the mining difficulty also goes up quite a bit. It could even out. But that's a losing proposition over the long run. Over 3 to 5 years, the Bitcoin value, they lose I want to say most of their, I don't want to say exactly most, but they lose between 80-90% of their value. There's always residual value that is left in the power supply, the transformers, the fan, the shell, the electronics board. They have a few uses for, say, hobbyists, but they make no mistake, they lose between 80 to 90% of their value. Sometimes the cooling systems can retain a little bit of value, but they will lose 80 to 90% of their value over a 3 to 5 year period, after which they flatten. And that is mostly because they do not become efficient. They are not efficient anymore to operate after a 3 to 5 year period. So that's the mining rigs for you. The mining rigs is the dangerous part of the business. That's the dangerous part of the business. That's where a miner can lose a lot of money, right? When you operate those rigs, though, and you mine the Bitcoin is mined and added to the bag. Now, the third way, and of course you make money on the bag because the bag goes up in value, right? If Bitcoin rises, the money that you have invested in Bitcoin rises. And so in that part, the hodl bag part is no different than a MicroStrategy. Now, what about access to power? That's part number 3. Here this is a gift in many ways. If you look at what happened to Wolf, for example, if you look at some of the interest of hyperscalers for AI, this is something that we did not discuss 2 years ago when we talked about miners. But today, the access to power that many of these miners have gotten their hands on in 2021, 2022, the access to that power has become very valuable and is becoming more and more valuable. In my analysis of miners, I have assessed a value of $300,000 for a megawatt of power access. That would be about 900 homes. Cleanspark, for example, has 1,100 megawatts. IREN Energy has 2,300 megawatt. I suggest you have a conversation with an AI about this, and you will find that I'm very conservative. In many cases, you can find instances where accessing a megawatt is $700, $800, even $1 million. So I'm very conservative. It fluctuates wildly, and of course, the access to that power has become much more valuable. Why? Well, to a lesser extent, you could say it's valuable to Bitcoin mining to a lesser extent, but it's become valuable because of AI. It's got a partial correlation to AI training, specifically training, not inference. When you do inference, i.e. having a discussion with a model, you need to have, 99.95 something percent redundancy. So you need to have a high class data center whenever you want to engage in things like inference, like a discussion with AI, like running an actual operational large language model. But when you do AI training, when you train the AI, which is the other part of AI, for those workloads, you really don't need to have the best uptime. You don't need to have the best internet access. And as a reason for that, this is the reason why energy in the middle of nowhere is still extremely valuable to AI training, even though you could easily make an argument it's not valuable for AI inference. It's not going to replace the data center in data centers in coastal cities, for example, that are very close to the optic fiber, but it's definitely gonna shift some of that power demand towards AI training, which does not require the utmost redundancy and the highest internet access. Now, I want to say this is changing in 2 ways too. Remote locations become more and more valuable in 2 ways too. First of all, you have the impact of technology and Starlink. What impact could that have? Like, could you have a really, really high debit internet connection in the middle of nowhere within, say, a few years? I think probably. And also you can use batteries to alleviate the downside. So that story is not over. But right now, with the limitations of isolated power, we can say that this is good for AI training. And sure enough, we've been shown this many times in the market. That power has value for training. And every company is going to have some training at some point, has some training to do at some point. AI is a developing story. It's an ongoing story. I don't think we'll ever be done training new models. There will always be demand for AI training models. Okay. So now that I've described the main aspects of a flowchart, you may ask, how does the Bitcoin miner make money? Well, let's go. How do you make money? Well, you fund the operation. So you make money typically in two ways. The main ways that you may make money by mining Bitcoin is you mine Bitcoin, every 10 minutes, the teeny tiny bit of Bitcoin that you mine from the mining pool that you're in. It's recognized as income at the time it's awarded to you. And so if it's recognized as not as income, I meant revenue here. It's recognized as revenue from the time it's given to you, and so it's recognized that revenue, and the revenue, of course, flows through your income statement, and hopefully, from the moment you recognize revenue to the end where you've recognized it in the income statement, hopefully you have a loss. And the reason why so many Bitcoin miners operate at a loss is because of a new depreciation that you have from added mining rigs. Because these companies are always adding more rigs, you always have more depreciation coming. And of course, depreciation is a phantom expense on the balance sheet. It does not exist. Well, I'm sure Charlie Munger could make the case that in the case of a mining rig, the depreciation is very, very real. But nonetheless, that depreciation also means that you get to reduce your taxes and oftentimes simply pay no taxes thanks to the depreciation, the new incremental depreciation added from perpetually growing the number of rigs that you have in the business. And sometimes it may even make sense for miners to just remove out of operation miners that are still making money and still mining. You take them out of operation just so you can claim new depreciation on new miners, right? That's a calculation that they can do. So that's how you make money. So assuming as soon as you recognize revenue, you sell that Bitcoin. When you sell that Bitcoin, as soon as you recognize the revenue, you're not going to incur capital gains. Now, you may incur capital gains, on the other hand, if you wait to sell the Bitcoin. But my hope for when I buy a good miner, my hope is that they don't sell the Bitcoin. That is my hope. But anyways, if you use your Bitcoin to finance your operations, to fund your operations, at some point you're going to have to sell it. When you sell it, you can sell it to pay for the power access, or you could say, and of course that's the cables, the utility lines with the utility company, or you could sell it to pay for your electricity prices that you need to mine your Bitcoin, or you could even sell the Bitcoin for growth. You sell your Bitcoin to buy new rigs and grow more, and then you make more Bitcoin and you sell the Bitcoin right away and you fund the operations again. And when you do that, you can assume a company that is sort of a closed loop without much dilution. Now we know that Bitcoin miners, just like MicroStrategy, they are financial engineers. So enters the dilution, the so hated dilution by most traditional investors. Most traditional investors will have a blanket hatred of dilution. They cannot stand dilution of your shares. But I personally believe that in the case of MicroStrategy, just like in the case of a Bitcoin miner, dilution makes a lot of sense. So in a business that dilutes to fund the operations, this is the dilution of Cleanspark right here, for example. So you dilute your stock, i.e. you have an ATM where you just tender new shares, you offer new shares to the market. At the market, you have an ATM offering and the cash comes into the business. You turn dilution of your shares into cash. What do you do with that cash? Well, you can use that cash to fund new mining rigs, you can use that cash to fund access to power, and you can use that cash to fund your electricity cost. So the cost of operating the business, funding the operations of the business in this scenario, which is what IREN does, in this scenario, you sell the Bitcoin to buy the rigs, buy the power, and buy the power access, right? In the Cleanspark example, you use dilution to buy the rigs, buy the power, and buy the power access, the electricity access, and the power. You get what I'm saying. And what advantage do you get for that? Well, the advantage you get for that, you get it in the form of a bigger hodl bag. That accumulated Bitcoin, it's essentially the same as what MicroStrategy is doing. MicroStrategy is issuing debt, issuing equity to buy Bitcoin, and so you end up in a situation where the capital gains of the Bitcoin don't have to be taxed because Michael Saylor does not intend to sell his bag. A miner hopefully does not intend to sell the bag either. But if the miner keeps the hodl bag forever, then you're not going to incur capital gains on that. You only make money on the revenue that you recognize as you mine the Bitcoin. Like I said earlier, hopefully you have enough depreciation to pay very little income tax on that. But your operations in that scenario, they do not force you to sell your Bitcoin. It is your dilution that pays for the power, that pays for the power access, and that pays for the mining rigs. So it is a more complicated MicroStrategy in a way. Is MicroStrategy dilutes the shareholder to buy Bitcoin accretively and taking advantage in differences in demand for the stock and volatility of the stock. A miner, a Bitcoin miner like a Cleanspark, dilutes shareholder to operate a business that allows them to accumulate Bitcoin at a discount compared to the trading price, and then holds the Bitcoin for the long run. So in many ways, a Bitcoin miner is kind of like a MicroStrategy, but with bigger business risk, because there's obviously more business risk, right? MicroStrategy could be run by 10 people in an ivory tower somewhere, and you have a office, a couple Bloomberg terminal, 10 financial engineers. That's all you would need to run MicroStrategy, right? When it comes to Cleanspark, you need hundreds of employees. So you have a lot of operational risk. But the benefit of that is that you end up mining a Bitcoin for something like $30,000, and Bitcoin is trading at 76. And so it makes sense for you, if you're Cleanspark, to dilute by $30,000 to mine one Bitcoin that then you add to the balance sheet, right? So you kind of like do a 2x, 2.5x. So that's the whole idea. And it's up to the shareholder to kind of quote unquote pick their poison. Do you want them to sell the Bitcoin and you want to see no dilution, or do you want them to actually not sell the Bitcoin and see dilution, knowing full well that these companies, they're gonna have an incentive to dilute anyways. So you might as well. I mean, I don't know. I don't, for a Bitcoin miner, just for like MicroStrategy, these companies are entirely different animals. They run an entirely different technology. Half of the story of these companies is about the new digital money, the new system. And as a result of that, dilution doesn't mean what it used to mean back in the day in that case. And so anyways, obviously this was not financial advice, not investment advice, just entertainment, hoping you were entertained. Please like, please subscribe. Follow me on Patreon, follow me on X, comment. Have a wonderful day.